Is this rally in stocks unstoppable? Joining me now are James McDonald, CEO of Hercules Investments, also Brian Weinstein, head of global fixed income at Morgan Stanley Investment Management, and perhaps because we just ended with Rick Santelli talking about the bond complex, Brian Weinstein, let's talk a little bit about whether or not the massive bull run in bonds is over.
Well, for a little while. I think we tested how far we could go in Treasury yields down on those 50 basis points for a 10-year note, and there's a lot of supply coming. It's gotten quiet. People have gotten long. But listen, I think on the other side, the Fed is still out there, right? Yield curve control is still a threat. I think the idea that 10-year notes are going to go wildly above, say, 1% is hard to believe. So, yeah, we've probably done most of the work for now as far as low yields. We'll come back to it in a bit, but some room for yields to go a bit higher.
So James McDonald, let's talk about what it looks like from a person who has to look at the overall market. Is your view somewhat changed given what you saw out of the fixed income complex over the course of this past week? Does it mean that we are due for more volatility all across asset classes going into the November elections?
Volatility is imminent. It's unavoidable if we study markets on a weekly basis, monthly basis, decade basis. Whatever time period you look at, volatility is real. But in this particular environment, we have factors that we've never experienced before with the pandemic. We have to closely watch data. We have to listen to our government officials tell us what's going to happen with treating this thing and preventing. Schools are closing, maybe no college football. It's a very, very different environment than other situations where we had volatility. We got new data today. We got retail sales. We're back above pre-pandemic levels. July purchases were up 2.7% year over year. And so we are able to get clues as to where things are going. But we're prepared for volatility. It will happen. We expect to profit from it or protect accounts from it.
All right. So we're going to work on some of the technical difficulties there with James's feed. Brian, I'll turn to you there. James mentioned clues, things that he's looking for. Are there things in particular right now that you are looking for or looking at with regard to whether or not we see markets able to sustain their current rally and whether or not we do see volatility heading into what could be a very volatile election season?
Yes, for sure. I mean, what's interesting is I think the first couple are not subtle clues, right? We need to know the outcome of stimulus, right, which is binary, and we need to know the outcome of vaccine, which is also binary. So those are a little bit hard because you have to decide which way the right way to lean is. Our view is you're going to get stimulus and you will get more good news on medical treatment. So that means keep your risk in fixed income, keep your income, because let's look at global yields. Income is really hard to come by. I think once you get through those, then you have to get a bit more subtle, right? We're priced for a good outcome. It's not clear that there isn't more long-term damage. So, we can't be afraid to take profits in low-yield environments when things get a little bit too optimistic.
So, I mean, it's fair to say that things are fairly optimistic right now. We have a market that's just about near record highs. Yields are still at very historic lows at this point right now. Is there still some kind of relative value? You look at the entire fixed income spectrum. Where should investors and traders be putting money right now relative to everything else in the credit or treasury or government space?
I think on the safer side, the 0 to 5 year credit investment grade spectrum, while not exciting, is still better income than most of the securities around the world, and you have a Fed backstop there, and those companies are in good shape. I think away from there, we like things where dollar weakness helps. So there hasn't been as much money into emerging markets. They've started to catch up. There's still yield there in credit space and some more local markets. And then, listen, high-yield markets are harder, right? High-yield markets, you have to be active. That's where I think there could be some steam valve where there's too much optimism and you get some chances to buy cheaper levels.
Are there certain places within credit and high yield specifically that are more attractive than others?
Yeah, I mean, I think there are definitely some middle market high yield names that have lagged, right? I mean, a lot of this momentum has been into things that are big and tradable in an ETF world. So I think as we're not and we're more active, we can find smaller issuers. Places like gaming and things that have been really, really beat up. We haven't been as aggressive in energy where it's just not as clear. But I think, away from the big names in ETFs, I think high yield active managers have an advantage because those names have lagged.
All right, James McDonald and Brian Weinstein, thank you both for your thoughts. We appreciate it.